Bennett Griffin and Chula Garza organized Coal Valley Bookstore as a corporation. Each contributed $80,000 in cash to start the business and received 4,000 shares of common stock. The store completed its first year of operations on December 31st of the current year, and on that date, the following financial items for the year were determined. I'm going to just read it, what you see here, okay? So the current year cash on hand was $75,600. Amounts due from customers from the sales of books, that means they made sales on open account. They allowed the customer to take possession of the books, transferring title, in exchange for the customer's promise to pay for the books, was $39,000. There was an unused portion of store and office equipment worth $73,000. Let's see, what else do we know? The amount owed to publishers for books purchased was $12,000. So here the publisher said, we'll give you legal title to the books in exchange for your promise to pay for those books at some point in the future. There was a 1-year note payable to the bank for $3,000. No dividends were declared or paid to stockholders. So our first requirement is to complete the balance sheet. And then we'll tackle the second requirement. So let me slide on down. All right, so they told us the cash in the bank was $75,600, so we're going to have cash $75,600 appearing as the assets. They also told us that the amount due from customers was $39,000. These represent sales we made on open account, and until we get paid, that shows up on our balance sheet as an account called accounts receivable. So that's where the $39,000. They told us the unused portion of store and office equipment is $73,000, so we'll record that as an asset. That actually would be a long-term asset because it's going to be used in the business for more than a year. All right, and then on the other side of the equation, we have liabilities. They told us that the amount owed to publishers for books was $12,000. Now, you can think of accounts payable as the opposite of accounts receivable. Since the vendors gave us legal possession of these inventory items, the books, we have an obligation to pay for those books at some point down the road. They sold it to us on open account, which means you get legal title now, but you pay for the books down the road. Well, we have to record that obligation, right? That's a liability of $12,000. We also have a 1-year note payable to the bank. That's also a liability for $3,000. Now, I don't think they told us about the interest payable, and that's got me thrown. It looks like this problem should have told us what the interest rate was on that 1-year bank and that we owed money, probably 10% on it, because that's where we're getting $300 as an interest payable. So that's included in this problem, but I don't think the problem gave us that information. Okay, so that's our assets and liabilities. Now, $80,000 in cash each to start the business. So if this is a corporation, we would have common stock equal to 80,000 times 2. I'll slide down. You can see there's 160,000. Okay, and then they say, what was the amount of net income for the year? And they told us, use the retained earnings equation. Beginning retained earnings, that would have been 0, plus net income minus dividends to come up with ending. Well, what you have to do is work backwards and say, well, we know what the total assets are, and then we know what the liabilities are. So assets minus liabilities would force us to compute the total stockholders' equity, right? Remember that total assets are equal to liabilities and stockholders' equity. So if we know that liabilities and stockholders' equity are 187.6, which is the same as total assets, and we knew what total liabilities, then we force stockholders' equity. That becomes 172,300. And since common stock was 160,000, the difference had to have been retained earnings. And given no other information, that's how we would solve for what the net income was for the year.